we're a little bit after 9, so maybe we can just go ahead and get started. If you wouldn't mind kind of giving a little bit of an overview for what we're going to look at today.
Yeah, absolutely, and thank you, Paul, and thank everyone for taking the time to join us today. And I apologize for the technical difficulties on my end. Gotta love new technology, but thank you again for taking the time to join us today. On the line, we have Paul and Nicole and some members from their team at Impact DataSource to discuss and really introduce this great tool that they have. And part of that, many of you remember that IMPA has provided a very similar tool in the past to really help you with that economic impact data for perspective and really to help retain projects. And that original tool was access-based, and it was great, and I used it, but now with everybody getting new technology, not everyone has access to the access program, but then I wouldn't say it was as user-friendly in the past. So Susan had met with Paul at a conference and really got a chance to kind of talk through some of the feedback that she had received on the tool, on the previous tool, and wanted to see how we could refine that and make it more user-friendly for all of you as you see new projects coming into your communities. So with that, I will go ahead and hand it over to Paul and his team to kind of walk through this. And please, don't hesitate to follow up with us for any questions, as we do have this model for a year through IMPA, and we will continue that moving forward as long as everyone seems it's going to be useful for them. So thank you all again, and look forward to walking through it with you, Paul.
Great. Thanks so much, Brian. And let me kind of share my screen here as I'm logged in to our model. But just to kind of to start up a little bit with what he mentioned was we have a web-based model that we've put together for the state of Indiana, so it covers really the entire state. And we're going to kind of, through Brian, will provide access to this model to all of the IMPA members. And so I think the process will be for you to reach out to Brian to request access. And I'm hearing a little bit of feedback there. I'm not quite sure what that is. Brian, is that?
Hello?
Is that? I'm not sure what that noise is. Can you hear that? Okay. Sorry about that. But just to kind of back up and give a little bit of a high-level overview of where we're heading with this model, we're trying to estimate the economic and fiscal impact of projects that you may be evaluating in your communities. And so in doing so, we're taking a look, and I'll just kind of jump in here and we'll come back out and take a look at how we get in there and how this is set up. But for right now, I want to just kind of show you maybe the punchline or the reports that where we're going with all of this information. And so ultimately, what we'd like to get to know is the economic impact of a project. And so how many jobs will be created in the community, and that would be from the direct activity as well as the spin-off or indirect and induced activity. To estimate our economic impacts in the model, as we see here, we have the jobs created and the salaries to be paid. We're showing direct and spin-off. We're using RIMS 2 multipliers. So from the Bureau of Economic Analysis, we're using multipliers from that data set specific for the community. And then we also think of economic impacts in terms of not just the jobs and the salaries, but maybe population changes. So if there's, for example, 100 new jobs being created in the county, some of those jobs may be filled by people locally, or they may be filled by people moving to the area. And so you have some ways to adjust those parameters in the model, but we have some defaults in there as well. And so these population impacts will drive some other things for the analysis as we get down to additional tax revenues and so forth. Another kind of big economic impact that we like to think about would be in terms of the taxable property. And so here we're showing the value of property on the tax rolls. And then with all of that information, we want to translate those economic impacts into fiscal impacts. And at a very high level, we summarize those additional benefits, costs and net benefits here in this detailed report on this table, showing what the county, the township, if there's a town or a city included, and then the other taxing districts that may apply as well, showing what they may receive over the next 10 years. So number one, the analysis is looking at it over a 10-year period. The other thing is, as we scroll down, we can see more specifically what are the sources of the revenues or benefits, what are the sources of the costs. I'm going to talk about this in a little bit more detail as we come back to this, but we can see, just generally speaking, that we're showing over a 10-year period kind of those benefits, costs, and what that looks like on a year-by-year basis for each one of the taxing entities. Again, as we're on this page here, this report page, this is the detailed report. We also have a summary report that really just focuses in on the county's impact, and just kind of rolled up into one page. What does that look like? That's kind of where we're going with this big idea. As I talk about economic and fiscal impacts, that's what we mean, the jobs and the salaries, the taxable property, and those being economic impacts, and then the fiscal impacts being the additional revenues and the additional costs for local taxing entities. If we back up now just to talk a little bit about the setup of the model. As we're logged in here, I'm logged in as an administrator, and I'm kind of viewing the Indiana Municipal Power Agency client that I created here. What we would do, as I mentioned, is create a client for each user, so that you can log in and you'll see your specific project. So you won't be logging into an overall Indiana Municipal Power Agency and everyone else can see your projects and that sort of thing. You'll have your very own login, and you'll see a list of projects. Right now I just have one project set up. This is our test project. You can create a new project just by clicking here and giving the project a title. This tile here will list how many scenarios you have. So if we click in here, we can see that we have one scenario so far. We could copy that one, or we could just create a new scenario kind of within this project. So you think of this hierarchy a little bit as you have a project, and then essentially within that project, it's like a folder, and you can do multiple scenarios. So if there was some discussion for a particular project, if they were going to have a ramp up of 100 jobs, or if all the jobs were going to come in the first year, you could do those two different scenarios. Or you could do scenarios where you include economic impact multipliers, or a scenario where you don't use any multipliers at all. So it's really flexible and nice to have those options. As we click in here now to scenario one, this is where we just were looking at the report tab, but now I'll kind of start in the normal way here on this scenario info page. The tab at the top we can see here for our test project. We can give our scenario a subtitle. So if we wanted to call this one the 100 jobs option, we can see what that fills in there, and that will flow through and appear on our reports. As we scroll down here on the left-hand side, we have some inputs, and as you see, I've already entered some information. On the left-hand side, we enter the project-specific information. I'll just scroll through some of this quickly, and we'll come back and look at each one of these. But then on the right-hand side, we have a dashboard that shows the impact of the project as we're calculating it kind of as we go. This is nice to kind of see how things affect the overall analysis as you're going along. But again, we have that report tab to actually look at either a one-page summary report or that multi-page detailed report. We have a tab here also called Public Support, and that is where you could model different types of tax abatements or exemptions, or possibly consider other incentives that may be an infrastructure grant or some value of an incentive for a project. Let me just walk through the scenario info page on the left-hand side, talk about some of these inputs, and just walk through this example. So we have a place to put a description of the project, and so this is where you could type in anything to describe the project and give context to the report, because this description will flow through to the report page, and then you can have that as a point of reference if you print off that report. The next input, we're trying to make it relatively easy for everyone to identify their tax district area, and so here we have the option to choose a county. We could select any county we'd like here. Say we select Decatur, and then once we select that county, within that we can select which specific tax district area this project may be located. And so if I go back, I can go back to Hancock here, Hancock County, and see our list of taxing districts has updated. And so if we were to select any one of these, we can see what the overall results look like. We're listing here, and they almost look like drop downs, but you can't select them. We're listing out each of the taxing districts that we're including in the analysis. So in this case, we do have a city. Sometimes a city will be not applicable if it's not within the boundaries of an incorporated area. But we can see that just based on this selection here of the tax district areas within the county, these are the tax districts that we're going to use in the analysis. You can see that we have a snapshot on a couple tax districts here, the county, the township, and the city. We're just showing the first three up here as options, but in the full detailed report, you would see details for that for the school district, library district, and special district, although they're not shown right there. As we scroll down again, we have the industry information. This is where you can identify what industry or business type this will be. And so here I've selected business support services, and then we pull in our multipliers that are specific to the area. So here we're showing a type 2 employment multiplier for this business support services of about 1.2. So what that means is that for every one direct job that would be created in the area, there would be about 1.2 total jobs. So that would be about 0.2 spin-off jobs. As we kind of look here already on this this dashboard, we see that we had typed in 100 direct jobs. That gives us the 22 or 22.9 spin-off jobs for the total of 122. The earnings employment, or the type 2 earnings multiplier, works in a similar way. For every $1 that's paid to a direct worker, there would be 27 cents paid to a spin-off worker. So in total, a whole $1.27 paid to all workers in that area. You can use this kind of drop down here to maybe select a different industry. So if we wanted to do something in machine shops, let's say in the manufacturing industry categories, we can select a different multiplier, select a different industry, which pulls in different multipliers. You could also overwrite these multipliers if you're using, if you're trying to make this, these economic impacts line up with some other program that you're running. Again, we're using RIMS 2 multipliers here in this analysis. If you wanted to use custom multipliers, you can simply click the custom option there, and then type in your multipliers, and the analysis will then use those custom multipliers. So this has a good bit of flexibility for you, and you should have a wide range of industries here for you to choose from. I think we have a link here, I believe. If you want to go look up NAICS codes, we would suggest using that link to the U.S. Census Bureau. As we scroll down, still here on the left-hand side, we're asking about the number of jobs that will be created. As I mentioned, we have 100 jobs. We're putting them all in year one. We're asking for the number of jobs each year. So if maybe these jobs are going to be phased in over time, we put in 50 in the first year and maybe 50 in the second year. We can see what that looks like as our graph is updating as we go. The next input here on this left-hand side is the percentage of jobs filled by new workers moving to Hancock County. So again, this goes back to that concept of 100 workers. Where will those workers come from? Some of them maybe already live in Hancock County. Some of them perhaps live nearby and will commute into Hancock County for this new job. But depending on the specifics of the project, you may expect a portion of those workers to actually relocate to Hancock County. So we have a default in here, and we've got defaults built for each entity, each county that would be reasonable based on our analysis and looking at commuting patterns and different things. But as you work a specific project, you'll probably have more information about that project and have a sense of whether you think that there should be any amount in this, or if maybe you know that they're relocating and they're actually going to be bringing quite a few of their own workers, and they'll be expected to relocate to Hancock County. So in that case, you can override this default. Again, if you know that it's 0 or something much smaller than 15, we could put in, say, 5%, and see how some of these things change the overall, or just go back to that default and leave that. As I'm scrolling down here again on the left-hand side, another key input is the salaries that are expected. Again, we're projecting this over a 10-year period. we're asking for the average annual salaries in year one, and then if it's easier, you can just hit an annual increase. So let's just say instead of 55,000, we thought it was going to be 50,000, and we wanted those to increase at 5% per year. And so when we do that, we can see that we're typing in the first year, and then these are increasing by 5%. If instead you wanted to have this not necessarily go by a percent increase, we could come in here and type in and overwrite these numbers however we'd like. And at any point there, they're going to continue to increase by 5% all on the way down. So this is kind of a little bit of a unique input here where we have the option to enter the first value and then a percent increase. But it's intended to make your life a little bit easier rather than having to type in 10 numbers each time. The next section, and this we really don't have that many inputs here on this scenario info page. The big ones, obviously, jobs, salaries, and now capital investment. And so here we have 3 different columns for the capital investment. We have land in here because essentially what we're trying to do is get down to taxable value and the taxes that may be on the tax roll. So generally speaking, I would leave land at 0. If maybe this was a scenario where the land was publicly owned and they were going to sell that land to a private developer to do this project as a part of the project, then you might consider putting in the value of that land coming on the tax rolls. The column for buildings and other real property improvements, that can be thought of as maybe the amount that they'll spend for construction of a new facility. In this case, I've got only $250,000 in real property, but a significant amount of equipment. So this building or this furniture, fixtures, and equipment, you can think of business personal property or tangible property. I'm asking again for the amount of the investment each year. So what we're saying here is that in year 1, the furniture, fixtures, and equipment will be $2.5 million, that investment, and then they're going to add another $5 million in furniture, fixtures, and equipment in year 2. So we're going to be kind of adding up the value of those that furniture, fixtures, and equipment. With respect to real property, the land, and then the buildings and other real property improvements, any of the values here will increase in value over time. So we're assuming that there will be some appreciation in the value of real property over time. With respect to furniture, fixtures, and equipment, we've built in a depreciation schedule, which over time will result in a declining value of taxable property here of this FF&E. If we want to see all of that in action, I'm going to just, we'll come back to this scenario info page, but just to kind of show you how this all translates in the report. On the detailed report, what we can see is the summary of taxable property over the 10 years. We can see the buildings and other real property improvements increasing slightly in value over time. And we can see our FF&E, we see $2.5 million in the first year, and then the second year we're adding a bunch more, but we can see overall, ultimately, it's declining in value. We're applying that depreciation schedule. So we're trying to be somewhat conservative and realistic in the terms of that FF&E. As I go back now to the scenario info page, I'll get back down to where we were with that capital investment. Again, if there were more phases to this project, maybe in year 5 they expect it to add some more real property, we can add that here just as we did. As we continue to scroll down, the last little piece is just building permits and fees. And so if there would be some building permits and fees to be paid, we could enter those here if those are known, and that would just pass through again as a revenue for, in this case, the county. So as we're looking at this page, we're entering information about the jobs, the salaries, and the capital investment, and we're going through with all of our economic and fiscal impact calculations. In this dashboard, as we're looking at it here, the job creation, this is just summarizing the direct and the spin-off jobs, the indirect and induced jobs, and the total. The salaries, the same thing, kind of showing the average salary, and then kind of the average spin-off salary, and then the average across all of the new workers. The capital investment is just summarizing the amount that we've entered over the 10-year period for that for the buildings and FF&E. So we see it's $8.25 million. And then this residential development number that we see here, it says 3.4 homes and 22.5 relocations. What that is representing is that out of this project, based on everything through the direct and the indirect activity, we're expecting about 22.5 new households to relocate to the county. And then out of those 22.5 new households, they may cause about 3.4 new homes to be constructed. And so when new people move to the area, they might not necessarily all build a new house. They potentially move into an apartment or they move into an existing home, but we expect that amount of relocations to cause some new residential property to be developed, and then that new residential property will be added to the tax rolls and may generate some property taxes for the local taxing districts as well. So that's kind of a high-level summary of what we've got going on here, what the inputs are. I want to talk a little bit now about the public support page, and this is where you can model different types of property tax abatements or exemptions and other incentives. So here, the way this is set up currently, we can identify maybe that we want to offer an abatement or exemption on the building, and we can specify an abatement schedule. So let's say that we wanted to exempt 100% of the property taxes to be paid on that building and other real property improvement. And so if that were the case, we can make our selection here with this checkbox and enter the schedule, and then we can identify which taxing districts will abate or exempt those property taxes. And so if we wanted to consider that from Hancock County's perspective, we can see what that looks like. So looking at it graphically, we can see that the real property taxes that we're exempting or abating here, it really only accounts for about $20,000 over the 10-year period. If we look at the property tax liability, it's about $160,000. This is, again, the property taxes that are on the firm's property, so the new business's property, that should be paid to or attributable to Hancock County. So this is $160,000 over 10 years. So what this represents really is if we were to add up these dark blue boxes over all the 10 years, if we stack those all on top of each other, they'd be about $160,000. And then these blue boxes, these light blue boxes below, are showing the total amount of property taxes abated each year. And that's added up, it would be about $20,000. So our net collected, which is represented by this kind of net line that we see that's just below the top of that dark blue box, that net collected is about $140,000. So we can see how that feeds back into the report. If we go over here, again, the full property tax liability was $160,000. The net collected from the business itself will be $140,000. If we look at the report, this is the summary report, the one page, we can see that there will be no real property taxes collected. We're actually already pulling out the $20,000, the value of that property tax abatement. We're pulling that out. And so when we see our benefits for the subtotal of net benefits of $860,000, we're already accounting for the effect of that abatement in these numbers. If you were to want to evaluate an option where you didn't have that incentive, where you didn't include that abatement, we can go back and we can see now that we actually have that $20,000 in real property taxes, and that's obviously increasing our benefit total and our net benefit total by that $20,000 amount. If we scroll down further, we have another section that we generically kind of call non-tax incentives. So this is intended to be an incentive where it may just be an infrastructure grant, or maybe you have a job creation grant, or maybe it's just the value of some consideration that you're making in trying to coordinate this economic development deal. So here, if we knew the incentive amount, let's say that it was just $250,000 was some infrastructure grant, and that was what the company requested your assistance. And so if we do that, we can type in the incentive amount here. We'll just throw it into year one as it goes, and we compare that incentive to what the county will get back. So here we're thinking about an incentive paid by the city, and so this is what the county's investment is in the project. We want to compare that investment against what the county will receive. The county's going to receive these net benefits over the 10-year period. So here, this orange line is representing essentially our net benefits over the 10-year period. And as we look at this incentive of $250,000, we have this total incentive reference line to help us see kind of a rough payback period. And so that shows us it's about 4.5 years. It's exactly 4.5 years as we've calculated it. If we think of this again as an investment, we calculate an average annual rate of return. We can see that we're calculating about 23% average annual rate of return. If we were to divide that out by the total number of jobs that were created, it's about $2,500 per job. If you wanted to look at other scenarios, some of our clients will set rules or general standards that they would only consider an incentive of a certain payback period, and so maybe that rule is a 4-year payback period, and so you can select here and highlight that and type in 4, and when we do that, we'll calculate what's the incentive that would get paid back in exactly 4 years. It would have a 26% rate of return, and it would be about $221,000. Depending on the incentive that you're offering, you can enter numbers over here as well. So maybe it was going to be something where you paid certain amounts over time, and so it was going to be maybe $150,000, but paid out kind of in uneven amounts over the time period, just based on performance or something like that. And in this case, we can see we've got these 3 payments of $50,000. Our reference line for the total incentive is up here at $150,000, and that intersects at about 3 years. As we see that this intersection, again, the intersection, this orange line being the cumulative net benefits for the county. This shows that it's about 3 years, so a payback period of 3 years, although we're not making our last payment till year 5. What that really means is that by year 3, the county will have collected enough in additional revenue and additional net benefits to cover the value of that incentive, the full incentive being $150,000. The county will have collected already that amount of money by this point. So even though they're not paying out the final amount till year 5, they're already kind of ahead of the game there by year 3. You can do a number of different options here. So if we wanted to do, again, maybe just $2,000 per job, we'll pay that out based on the hiring schedule. So if you remember, we had put it that there was going to be 50 jobs added in year 1 and then 50 more in year 2. And so that's how we can kind of come up with that schedule here. Now, as you make changes here and say that's what you want to go with, we can go back to these report pages and we'll have sections that show the analysis of those incentives that were considered. So again, with this $578,000 in net benefits for the county, we're comparing that to this $200,000 incentive to get our payback period and our rate of return. This summary report, again, this is a 1-page report that looks at things from the perspective of the county. We have the overall net benefits for the county, some itemized revenues and costs here. Graphically, we're showing kind of year by year what the benefits, costs, and net benefits are for the county. Below, we have that incentive graph we just talked about. On the left-hand side, this is where we summarize some of those economic impacts. We've got the jobs, the salaries, capital investment, and the residential development. And for reference, we've also got a summary of the net benefits over 10 years for the other taxing districts that we can see that the township over the 10-year period will get about $5,000 in additional property tax revenue. The city will get about $300,000 here in this case. Just to kind of go into a little more detail on the types of revenues we're calculating here, we're including income taxes, and we're trying to we take a look at the various local income taxes that the county has, and then how those ultimately get distributed. So you're not seeing the total amount that the county, that's collected countywide necessarily for the county. What we're seeing is the amount that the county gets net after some of those distributions to other taxing entities. For example, if we look at the city or even the township, in this case, Center Township will receive a few $1,000s in income taxes based on kind of the way everything shakes down through the distribution of those local income taxes. In these other categories here, we're looking at real property taxes and the FF&E property taxes. The new residential property taxes, this is based off of, again, the new workers moving to the area and possibly some of those building new residential property. We're estimating that here as well. And then let me go back to, sorry, the summary report page. We have a category called miscellaneous taxes and user fees, and then we also have a category called the cost of government services. So what do we include in this miscellaneous taxes and user fees? Well, we tried to itemize, using this model, we tried to itemize as best we could the income taxes, the property taxes, and any other sources of revenue, like perhaps the building permits and fees. We tried to itemize those as directly as we could, but the county, or in the case if we were looking at a city, or if we were looking at the school district perhaps, these taxing entities will receive revenue from other sources other than just these that we itemized. The property taxes and income taxes are probably the largest percentages, or they certainly are the largest percentages, but there'll be some other revenues that these counties and cities and so on receive. So we've got this category called miscellaneous taxes and user fees, and what we're doing is looking at within each county or within each city what are the additional sources of revenue, and how does that compare currently to their number of residents and their business activity. So we generally think that a city or a county will receive revenue from the residents. They'll collect, whether they're taxes or charges or fees or licenses, they'll collect revenue from the residents, number one, and number two, from the businesses themselves, whether they're again, charges for services or licenses and other taxes that may be filled. So what we do is we add up all of that miscellaneous revenue, separate it out to some extent by what portion would be attributable to businesses and what might be attributable to residents. Generally speaking, that's about 70% for residents and about 30% for businesses. We're doing that kind of based on property use. And then we calculate and try to identify currently for each household in the community how much of this additional revenue is generated through these miscellaneous taxes and user fees. So then we might get a number, a per household number of $300 per year per household, and then we'll use that number to apply to these changes in population, as we mentioned, maybe 22.5 new households moving to the area. The same thing would go in terms of businesses. We would look at the total number of employees as our index, and so for each job that's created, there may be maybe it's $50 per new job or something like that coming through this miscellaneous taxes and user fees. And so we're just trying to make this a complete analysis where we reflect the fact that the county will receive revenues from other sources other than just income taxes and property taxes. Now, on the cost side, we need to acknowledge that there'll be some additional costs for the county or the city or even the school district to provide additional services to these new residents or to these new businesses. And so we do it in a very similar way where we try to estimate a marginal cost to provide services. And so in that case, we'd be talking, or we'd be looking at the costs or expenditures that a city or that a county would have with respect to police, fire, EMS, the highway maintenance or road maintenance, parks and recreation, those sorts of things. And we try to estimate the marginal cost for a new household coming into the area and so on. And so in the case of a school district, we look at it in terms of new school students. So one of the line items we have here in our population impacts the number of new students attending the local school district, based again off of these workers moving to the area and total number of households and so on. We're assuming that a portion of those households may have new school students that would need to be educated and so on. So that is kind of at a high level what we're doing to kind of pick up some of these other revenues that you see here. The biggest focus and the main driver of the analysis, of course, is going to be these income taxes and then the real property tax, or excuse me, the property taxes generally. I understand that there's a 3% property tax cap on non-residential property in Indiana, and so we've incorporated that into the analysis. So you'll, as these set of taxing districts come together, if the tax rate is above 3%, it gets capped just in the same way that it would in the real world. And then with respect to residential property, we're acknowledging the 1% cap in that case as well. that pretty much ends up. If anybody has questions, I don't know that any questions have come in yet. If you have questions that you want to ask now that maybe I could handle, if they're kind of a general use variety. If they're really specific, I can possibly follow up and talk to you one-on-one or with an email. The other thing, just as at a big picture level in terms of using the model. It is not compatible with Internet Explorer, so I would suggest you use anything other than Internet Explorer. It works very well with Chrome, and some of the printing that we have in here right now is kind of reliant on the browser printing, and so Chrome seems to do the best job with actually being able to print and save these reports. So I would highly recommend that you use Chrome to access this website and to use the model. Again, the process for me, will be, I think Brian will kind of be the point of contact, and then I can create users for each person that contacts us. I believe I'm looking at the question, trying to scroll through these questions. So one question here, and I don't know why I cannot read these. Will you have the impact report available as a PDF that can be emailed to the webinar guests? Sure. So just as an example, I can make a PDF of this and make it available to everyone. In general, how you would do that is to click on that print button, and then you'll be able to just save it as a PDF, assuming you have a PDF writer. Another question here. We have a user guide that will be available that will have more information on all of the background of the model, how everything comes together, and on these miscellaneous taxes and user fees, as well as the cost of government services. If there's a question also about changes as local income tax rates change or as property tax rates change, that's part of the support or ongoing support here with this model. And as the tax rates would change, or income, property taxes, we've currently built in the 2016 property tax rates for Indiana statewide. The income taxes, we were using the most recent data available, and and I think that's 2015 to be honest, as soon as there would be a new set of data available, we could update the appropriate way there with respect to the income taxes. Let me just see if there are any other questions here. There's one last question, I think, looking at public projects. And how you would do that. Can the model be used for public projects, or is it designed for only industrial? Well, I think in general you would have just this steps back a little bit from the whole thing. This model is really intended to tie back those economic impacts that would result from some new business activity and translate those into costs and benefits for local taxing districts. Some of the public projects would have probably reduced impacts in terms of the fiscal benefits, a lot of things being exempt from taxes perhaps, but they would also have kind of different motivations on the upfront, and so there's probably a different story to tell if you're looking at a public project versus if you're trying to decide on incentives for a particular project and being able to use some quantitative numbers of looking at the net benefits of the project. If there's more, we can talk more specifically if the if we want to, if there's more to that question. There's a question here, and it maybe includes some background. The IEDC's modeling tool allows for addition of a discount rate to account for inflation over the abatement period. Is that available here? In general, we do have a standard discount rate that we're including in the model here. So as we present the present value, these are the discounted revenues over the 10-year period, the discounted net revenues. And we're using a 5% discount rate. We're about to release some changes to the model, or not really changes, but enhancements, where you'll have a lot more control of some of those other parameters. So, for example, if you didn't think, or if your community wanted to use a different discount rate than 5%, you could go in and adjust that. And so I think that's pretty much everything I wanted to cover. Let me see, Brian. I had you muted for a second. Let me see if I can bring you back on. Brian, are you there? Is there anything else that you wanted to kind of say, or maybe remind me that I forgot?
I just get one question asking what IMPA is looking to get out of this, and this is not looking to receive anything. It's merely just an additional tool for our members and the leaders around the state of Indiana to help, you know, in their pursuit of projects throughout the state. And I did actually receive a couple questions regarding the scenario information when you're talking about the multipliers for specific industries. Can you touch base a little bit on that, as far as if there is a reason where you thought there was a reason to maybe change that particular multiplier? And I do know that they continue to change considering what industry that you're talking about.
Yeah, so multipliers are region specific. And industry specific. So as if you know, a manufacturing business would have a larger multiplier, generally speaking, than maybe just say a restaurant, food services industry. And it all ties back to how money is spent in the community, and how much is you know, how much leakage occurs outside of the local economy and that sort of thing. I would recommend, you know, sticking with these industry multipliers that you can select here as you choose a specific. If we look at business support services, if I go back to that one, and just using the multiplier that pulls in from the model. We give this option just in this for the sake of flexibility in terms of entering custom multipliers. If you know, if you had, like I said, another analysis, and maybe it was prepared using a different model, but you wanted to, you know, make sure that everything was aligning, at least with respect to that, but to kind of, you know, use our model to maybe evaluate some fiscal impacts. This would give you that full control to kind of tweak that. Clearly, if you go in here and you put in an unreasonable multiplier, and I'm going to call 5 an unreasonable multiplier, we can see we'll probably not have great results. If we really monkey around with this thing, we can see that you can really change things quite a bit. But if you're, you know, if you're looking at you know, just making this either align with something else, or maybe to refine it a little bit, it's just that extra piece of flexibility there.
Also, to clarify again, this is a free tool for IMPA community members. So if you or someone from your organization has interest in getting access to this, please contact me, and I'll work with Paul to set up a user and logon information so that you and your team and members of the community can be able to use and access the tool.
Well, I think that does it for me, Brian. If there's anything else, I think we can kind of wrap this up. Like I said, we are recording it, so we'll make this available if other folks want to view it later, or if you want to view it again. If anyone has specific questions and they want to reach out to me directly, they certainly can. It's just Paul at Impact DataSource. Like I said, to request access, just feel free to reach out to Brian, and then we'll work on getting you set up in here and getting your login. But again, thanks thanks everyone for joining us today, and I look forward to working with you over the next year or so. Thanks.